The letter arrived on a Tuesday in March. Nadia set it on the kitchen table and stood there, coat still on, keys still in her hand, for 6 minutes. She recognized the return address. When she finally opened it, the number was $97,412. The IRS had reclassified her retirement rollover as a taxable distribution. The 60-day window had closed on day 61. Nadia Okonkwo was 47 years old and had worked at St. Francis Medical Center in Baton Rouge for 17 years, first as a billing analyst, then department coordinator, then director of administrative operations. She managed 43 direct reports and knew every line of the hospital's operating budget. Outside work, she tracked personal spending in a spiral notebook, column by column, month by month, for 11 years. She did not carry credit card balances. She had never borrowed against her 401k. Her retirement account balance in October 2019 was $218,400, built from paycheck deductions and employer matches, 1 year at a time. She had started at St. Francis at 30 years old on a salary of $44,000. She left earning $91,000. She did not think of herself as someone who made financial mistakes. In November 2019, Tulane Medical Center offered her a director-level position with a salary of $113,000. It was the kind of offer she had been building toward since 2016. She gave notice the same week. Her HR department explained 3 options for the 401k: leave it in place, direct rollover to a new custodian, or indirect rollover, a check issued to her directly, with 60 days to deposit into a qualified retirement account. She chose the indirect rollover. She wanted to move the funds into a single IRA she had maintained at a brokerage for 5 years. The plan was clean. The logic was sound. She had opened the new IRA account at the brokerage on November 22nd, the same day St. Francis processed the distribution paperwork. There was nothing left to do but wait for the check to arrive. The 60-day rollover rule appears in every retirement planning guide ever written. What those guides do not prepare you for is the assumption you'll make about when the clock starts. St. Francis issued the check on November 22nd, 2019. It arrived in Nadia's mailbox on November 26th. Federal law required the employer to withhold 20% of $43,680. The check she held was for $174,720. To complete the rollover, she needed to deposit the full $218,400, not just the check she received. The $43,680 withheld would need to come from her own savings, deposited alongside the check. She had opened the IRA online on November 22nd. The brokerage sent confirmation of the new account number by email the following morning. She printed the page and set it in the fireproof safe. On December 3rd, her phone rang at 11:47 in the evening. Her sister's name was on the screen. Their mother had collapsed in her apartment in southwest Houston, a hemorrhagic stroke, diagnosed by morning. Nadia drove through the night. She arrived at the hospital at 4:30 in the morning. She sat in a plastic waiting room chair with her coat across her lap until a doctor came out with a clipboard. She stayed for 13 days. She made calls from hospital corridors and the apartment parking lot. She reorganized her mother's home care plan with a social worker. She did not think about the check. She returned to Baton Rouge on December 17th. She opened the spiral notebook to page 14. She counted 60 days from November 26th, the date the check had arrived in her mailbox. She wrote, January 24th. She entered the date into her phone calendar and set a deposit reminder for January 22nd, 2 days early. She had built in a margin on purpose. That was how she approached things. The 60-day window does not begin on the date the check arrives in the mail. It begins on the date the distribution is made. The check was issued November 22nd. 60 days from November 22nd is January 21st. On January 22nd, her alarm fired at 9 o'clock in the morning. She drove to her bank. She withdrew $43,680 from savings and had a cashier's check issued. She placed both checks in an envelope. She drove to the brokerage's branch office on Perkins Road and sat down at the counter. She handed the envelope to the representative. The deposit was processed. The account balance on the screen read $218.400. She walked out to the gray Accord in the parking lot and sat before starting the engine. The account was funded. 17 years of retirement contributions were now in a single IRA. She drove back to Tulane. She thought she was being careful. She had built in a margin. She had funded the gap from savings and deposited before her self-calculated deadline. The deadline she missed was the one she never knew existed. The IRS processes tens of thousands of retirement distributions each year that were intended as rollovers. The 60-day indirect rollover rule generates more inadvertent, taxable distributions than any other single provision in the Retirement Code. 8 months passed. She started at Tulane, adjusted to the longer commute and the new team. Her contributions to the new 401k had already begun accumulating. The IRA sat untouched in the background. The IRS notice arrived March 11, 2020. It was addressed to Nadia Okonkwo. She opened it at the kitchen table without setting it aside. She recognized the form number from her years in hospital billing. The notice reclassified the full $218.400 as ordinary income for tax year 2019. St. Francis had filed Form 1099-R in January 2020. The IRS had been cross-referencing it against her filed return since February. The additional income, $218,400 added on top of her 2019 salaries from both employers, pushed her into a combined federal and Louisiana state marginal rate of approximately 36.25%. The income tax on the distribution was $79,170. The early withdrawal penalty added $21,840, 10% of the full distribution, assessed because Nadia was 47, more than 12 years below the IRS threshold of 59.5. The combined assessment was $97,412. Against the $97,412 assessment, the IRS applied the $43,680 that St. Francis had withheld as a credit. Her outstanding balance was $53,732. Her savings account held exactly $31,000. She read the notice twice. She opened the calendar on her phone and counted from November 22nd. She landed on January 21st. She counted again. She got the same date both times. She called a tax attorney. The attorney told her the IRS has the authority to waive the 60-day rule in cases of financial institution error, medical emergency, or circumstances demonstrably beyond the taxpayer's control. Her mother's stroke fell within the qualifying categories. The attorney explained two paths: a private letter ruling, months of legal fees, uncertain outcome, or a self-certification form under Revenue Procedure 2016-47, which she could file herself. She filed the self-certification in May 2020. She attached hospital admission records, discharge paperwork, and a written timeline of her absence in Houston. She submitted it by certified mail. Then she waited. The IRS responded in August 2020. The denial letter was one page. It acknowledged the medical event, the hemorrhagic stroke, the dates, the 13 days in Houston. It denied the waiver on a single basis. The denial noted that 35 days had remained after she returned from Houston. The IRS determined that was sufficient time to complete the rollover. She had 35 days. She used 36. Nadia applied her $31,000 in savings to the outstanding balance. She entered an IRS installment agreement for the remaining $22,732 at $1, $591 per month for 14 months. She paid the first installment in September 2020. The $174,720 she had deposited into the IRA was redesignated. The IRS does not recognize a deposit made after the 60-day window as a rollover contribution. The account was reclassified as a standard taxable brokerage account. The money was still invested in the same funds she had chosen. It had not disappeared. But it had lost its tax-deferred status. Future gains would be taxed as capital gains rather than growing sheltered until retirement. At 49, Nadia had no IRA and no 401k balance from her years at St. Francis. She started over. She contributed the maximum allowed to her Tulane 401k, $19,500 per year, plus the catch-up contribution once she turned 50. She rebuilt $54,000 in tax-advantaged retirement savings in 2 years. The $218, $400 she had carried into 2020, 17 years of compound accumulation, was gone as a tax-sheltered position. The gap would take more than a decade to approximate. The installment plan ended in November 2021. The IRS closed the file. The notation in her tax records will remain for 7 years. There is no field for intent, only the date of deposit and the date of the deadline. She does not talk about the 61 days. Not to colleagues, not to her accountant, not to her mother, who recovered and now lives closer to her. There is no version of explaining it that lands cleanly. The paperwork still exists in a manila folder, the deposit receipt, the cashier's check stub, every document correct, every figure matching. 1 day off. That is the hardest kind of thing to carry. She checks the taxable brokerage account the same way she once checked the 401k. Same platform, same funds, same quarterly review. The tax treatment is the only difference. In early 2022, the account balance was $192,400. She is 50 years old. She has 11 years before a conventional retirement age of 61. She has run the projections. She knows the gap between where she is and where she would have been. The folder is in the second drawer. She knows where everything is. She has not opened it since November 2021. Some things are finished and still present at the same time. This wasn't the only time this happened. The IRS assessed rollover-related penalties on thousands of retirement accounts that same year. The 60-day window closes whether you know about it or not. It made sense at the time.